Welcome to Sense Financial and the webinar on the topic of Power of Inc. Tax savings during times of economic uncertainty. Before we jump into our topic, normally I'd like to just spend a few minutes to introduce to those who are unfamiliar with Sense Financial about what we do. And just a little bit about myself. I'm the founder and president of Sense Financial Services. My contact information is on the screen. Just a quick disclaimer that we don't provide legal investment advice. Tony is going to be talking about taxes, obviously, but here at Sense Financial, our experience is in self-directed retirement accounts. So I'm going to briefly share that with you. We are a boutique financial firm specializing in self-directed retirement accounts. And our niche is a checkbook control. We work with our clients to help them unlock their IRAs and 401ks and give them the ability to invest as simple and as quickly and as easily as writing a check and be able to invest in alternative assets. We've been serving our clients since 2010. Our clients love us because we make effort for that, and that's evidenced by hundreds of 5-star reviews online, Google, Better Business Bureau, Bigger Pockets, and so on. Over the years, we assisted over 3,000 clients, established over 4,000 self-directed retirement plans. Most of our business comes through referrals. But we are on a mission to help our clients obtain control and protect their retirement accounts. Proverbs 21:5 says that good planning and hard work leads to prosperity. And we know that you work hard for your money. So we want to come along your side and help you. And that's the reason we actually have Tony today to help you navigate the tax questions. But the benefits of a self-directed IRA or self-directed solo 401k is that you have the ability to invest in alternative assets, meaning you can accomplish true diversification. Your investment returns are tax deferred when you invest using traditional account, or in case of a Roth, it's tax free. You can leverage your funds with non-recourse financing. You can actually buy investment property using leverage. The checkbook control feature is very convenient. And a solo 401k specifically is a great tax shelter because it enables you to shelter over $70,000 of your income from taxes. A great tax shelter. While you can do a lot with self-directed IRA, there are certain things that are certain restrictions, and the restrictions are defined in the Internal Revenue Code section 4975, which defines prohibited transactions. And that basically comes down to collectibles and life insurance. Those are the two investments that you're not allowed to invest with your self-directed IRA. And also, you're not allowed to engage in any transaction with disqualified person, which is yourself and your immediate family members. I think this cartoon, credit goes to my daughter back when she was 5, I think. And it illustrates well the situation when a husband holds a basket which represents a stock market, and the bottom fell off, and all the eggs are broken now. And wife is puzzled and says, I thought that our investments were diversified. Well, guess what? If you're keeping all of your investments or all of your eggs in one basket, they're not diversified. You actually can accomplish that by creating multiple baskets using a self-directed retirement account. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur in the earth. And it's true. I think we all experienced that with the stock market. It's been doing well over the last number of months, but not too far ago, we've seen significant drops. And so you can actually eliminate that or minimize that by employing alternative investments into your strategy. And alternative investments can be physical real estate, single-family rentals, or it can be commercial, multifamily investment property. You can invest in tax liens, tax deeds, precious metals such as gold and silver. You can invest in cryptocurrency. You can actually use your IRA or 401k and be the bank and lend money out to other people. This is actually one of my preferred method of deploying my own retirement funds. It's low risk, it's high yield, and it's completely passive. You can do all of that. And with this, just a little bit about what we do, and we're going to switch to our topic today, and that's going to be on the power of Inc., tax savings during economic uncertainty. And we're going to have Tony present. Tony he has spoken with hundreds of trade organizations throughout the state of California. He's holding a federal license as an enrolled agent, tax practitioner. He can advise, represent, and prepare tax returns for individuals, partnerships, corporations, and any other tax reporting entity. Aside from being a full-time at Robert Hall, Tony is active real estate investor. So he practices what he's preaching. He's an entrepreneur and enjoys short and long-term trading. With over a decade and a half of experience, Tony, along with his team at Robert Hall and Associates, actively look for newest and most up-to-date strategies to implement on the client tax filings. They operate with the same goal in mind, which is to help taxpayers keep more of their wealth and not overspend with the federal and state tax revenue agencies. And I'm a good example of that. I do utilize Robert Hall & Associates for my personal and my corporate tax preparation, and it's they've done a phenomenal job minimizing my tax liability. So with that, Tony, thank you for joining us, and the floor is yours.
Thanks so much, Dimitri. Yeah, this is it's always good speaking to an audience of like-minded investors. Obviously, as a real estate investor myself, someone who actively plans ahead to defer money into retirement plans and set up corporate entity structures. My wife is self-employed. She owns her own small business. I've got my own side businesses as well. So just like Dimitri, who practices what he preaches, I very much do the same. Today's topic is a little bit of a, I'm going to say it's near and dear to my heart because it was one of probably the first topics that I really became excited to speak about 14, 15 years ago when we started doing in-person seminars. And now obviously a majority of our education is online, but it's the power of Inc. And how to structure yourself and save yourself taxes during times of economic uncertainty. I wouldn't say that we're so much in a time of uncertainty right now as we were during the pandemic, but there's still and always going to be a need for planning ahead. We have an election coming up at the tail end of this year, a lot of changes on the horizon. So I think that this year, 2024, is equally as important as previous years to just set aside some time with your preparers, with your accountants to put a plan in place. I always mention in my seminars that failing to plan is ultimately planning to fail. That saying goes hand in hand in what we do here in the tax preparation industry. So make sure that you put a plan in place to succeed and not to fail. I myself have been working with Robert Hall & Associates for going on 2 decades. My individual column of clientele ranges in the $500 million range in managed real estate and other small business dealings. And I am the keynote speaker for Robert Hall & Associates, speaking at over 140 events, mostly here in the state of California, but I have traveled across the U.S. and spoken at other locations. And all of our education is free here at Robert Hall & Associates. To service all of the filings that our firm prepares, I by no means am a one-man operation. I work alongside a wonderful senior consulting staff. We're about 55 employees strong here at Robert Hall, and we do actually file tax returns in all 50 states, even though we only have one location nestled in the beautiful Glendale, Southern California area, right near the hillsides here in Glendale. We do actually file taxes in all 50 states, and we have clients that we service across the U.S. we're kind of a one-stop shop for all of your financial needs. Back in 1971, when Bob Hall first started the firm, he probably dreamed up this, and now that he's reached this eventual goal of having everything kind of under one roof, I don't think he could have ever imagined the kind of powerhouse that he would have created, now sitting in 2024, February 15th of 2024. We service around 11,000, well, it says 10,000 here. I think we're more like 11,000 plus filings per year. We have great reviews online, so check us out online, roberthalltaxes.com. And like I mentioned, we are kind of a one-stop shop for all of your financial needs. Obviously, our main service is tax preparation, but we do also offer incorporating services. We do payroll planning. We do financial planning. Obviously, we team up with great vendors such as Sense Financial and Dimitri to service our solo 401ks and self-directed IRA type investments. And we'd also do estate and trust planning here. So this is what Bob Hall dreamed up, back in 1971. He wanted everything under one roof. And we just have a very thorough, very lengthy list of vetted vendor referrals. So if you are in need of a cost segregation election, if you're in need of a 1031 exchange accommodator, you name it, we probably have it as a referral source. So keep that in mind. I will mention this at the tail end as we kind of move throughout today's webinar. We do offer free consultations, just a spotlight on some of our senior preparers here, Robert Hall, Candace Kane, Jackie Fu, and Randy Redmond. We are still available for appointments for the 2023 tax season, even though we're encroaching not the halfway point, but getting pretty close to the halfway point of tax season. But I will remind you about this towards the end as we enter into the Q&A portion. Like Dimitri had mentioned earlier, he's not a legal advisor. I want to mention that I am not a legal advisor, so nothing today, even though it might seem that I'm stepping out of my lane of expertise and possibly giving legal advice, I just want to mention that nothing I speak on today is by any means projecting legal advice or legal strategies to you. It is all strictly from a tax preparation and tax planning standpoint. We do have great business attorneys, real estate attorneys, estate attorneys that we can refer you to. But today is all about income tax, the IRC, the Internal Revenue Code, and the power behind incorporating for your small business or your rental investments. All right, getting all of that out of the way. Incorporating, is it right for you? This is probably the question that I've answered more of than any other question in my career, especially because I work mostly with real estate professionals, whether it be on the commission earning side or the rehab flipping short-term investing side or the long-term rental property holder side. Incorporating is always a unique conversation, and I just want to make sure that everybody understands that incorporating is not right for everyone. Just because we're talking about and discussing incorporating today doesn't mean that you should leave this webinar and go out to LegalZoom or to another, online website and start an incorporated entity. You got to sit down with your tax advisors, with your legal advisors, and make sure that incorporating is right for you specifically. In our initial consultations about incorporating with our clients, we always ask 3 very important questions that we need answers to so that we can advise and guide our clients in the right direction. Question 1 is, what personal assets do you own? Meaning, what assets are attached to your primary social security number? Do you have inherited investments like brokerage accounts or property? Do you own your primary residence? Do you have retirement plans? What is attached to that primary social security number that we need to protect and separate business liabilities from everything that you own personally? That's the number one question that we need to answer at first, because the number one benefit of incorporating is asset separation, which equals asset protection, and vice versa. So question 1 about personal assets. Let's say that you do own a primary residence, you own some rental properties, you have inherited assets. Okay, check yes to question 1. Question 2 is going to be about consistency of net profit. What is the consistency of your net revenue on an annual basis? Not the gross income that you're bringing in, not the gross rents or the gross commissions earned, but after all of your expenses are taken into account, what is left over at the end of the day that you actually have to pay federal and state income taxes on? What is the consistency of that number? And is it hitting that certain milestone figure where incorporating is warranted, where it might actually end up saving you more than it's costing you on an annual basis? After 19, almost 20 years of doing this, I've dialed in a pretty defined number that I like to look for in order to push or advise my clients in the right direction for incorporating. And that net revenue figure lands at about $35,000 to $40,000. So once again, if you're making $100,000 in income, you're spending $90,000 in overhead, you got $10,000 in net profit. Sure, incorporating might give you great asset protection and asset separation, but it's not going to save you more than it's costing you because your net revenue is below $35,000 to $40,000. Let's say you're bringing in 100 grand and you have very low overhead. Let's say $30,000 in overhead. You got net profit of $70,000. At that point, because you're above that $35,000 to $40,000 milestone figure, incorporating might actually end up saving you than all of the annual costs that you incur to file. And yes, at the end of the day, the payroll processing fees, the tax filing fees, the state of whatever state that you file in, I know state of California has an $800 filing fee each year just for parking the business in the state of California. We need to make sure that the annual savings is going to be greater than all of those costs. And even though those costs are tax deductible, by no means are they saving you $1 in tax for $1 paid, okay, for the expense. So we want to make sure that it's going to save you more than it's costing you. That's question number 2. What's the consistency of net profit? Question 3, normally we can answer question 1 and question 2 and advise our clients in the right direction, push them in the right direction. But question 3 is about risk and liability. In your industry, what levels or what certain risks and liabilities do you operate at or with in your specified industry? Well, I do taxes for a bunch of different businesses, anything from the entertainment world to the real estate world to, I just picked up during the pandemic a lifeguard instructing business. I have a skydiving instructing business I do taxes for. I have education in the aeronautics industry where there are pilots teaching and coaching people to become pilots. I mean, these are high risk and high liability industries that these individuals are working on. So whether you own personal assets and whether your net revenue is above 35 to 40 grand, some of these industries warrant incorporating for the future asset protection and liability protection, or reducing liability overall in that industry. So it depends on what industry you're in, and as much insurance as you might have for your business, remember that insurance is there and in place for a specific reason, which we'll get to in a couple slides here. But I did want to mention that some businesses will incorporate right from the get-go, even if question 1 and question 2 aren't checked yes. Okay, so let's keep that in mind. Now, once we decide to incorporate ourselves, either our rental properties or our small businesses, what are some of the options that we have? The 3 main options that most U.S. taxpayers will have at their to access is the limited liability company, the C corporation, and the S corporation. The LLC is by far the most commonly used entity for asset protection purposes, simply because the LLC is meant to do one thing and one thing only. It's meant to limit liability on large assets or large business ventures. So many individuals who go out and purchase a rental property or who inherit a rental property or are flipping businesses, flipping properties on the short term or long term, they'll utilize the LLC for the great liability protection on that large asset that's being dealt with in the business. I want to make sure that everybody understands that the LLC saves you nothing in income tax. LLCs are only for liability protection. They will absolutely save you zero federal and state income tax. It is only for that great liability protection on the business side. So LLCs, great for rental investments, great for large assets. I'll give you an example. Let's say you own an IT software development company and you buy $500,000 in server equipment, or better yet, a perfect example. I do taxes for a cryptocurrency mining company, which is a very unique business structure. And this crypto mining company, back in 2019 or 2020, they went out and bought close to $500,000 in server equipment. And they have these bins that they'll put ventilators in and whatnot with these solar panels on the top, and it'll keep the power running, very low cost overhead on that end. But they have these large assets that they are acquiring under their business. Now, the crypto mining business, which is a self-employed business, that is set up as a different type of entity, and then they rent the assets in the LLC to the S corporation. So this multi-level structure really ended up helping this business save quite a bit in tax, because they're protecting their assets separately from the business itself. We see this a lot with dentist and doctor practices, where a dentist will own the building that they operate out of, and the building will be held in an LLC, and then the dentistry practice will be set up as an S corp or a C corporation, and they will pay rent to the LLC that owns the property, and they'll allow themselves to separate the business from the actual asset, which is the building in this case. So there's a number of ways that we can structure this. It's very important for you to set up an appointment with your tax advisors, with your legal advisors, to make sure that it's all set up correctly. LLCs, no income tax benefit, only liability protection. Now, the C corporation in the tax world is also referred to as a double taxed entity, meaning that if you generate revenue at the C corp level and you have expenses, whatever that net profit is at the end of the year, you pay tax at the corporate level on that net profit. And then whatever you drew to yourself as a dividend, you pay tax on that individually as well. So you pay tax in two different places. C corporations are very unique entities. There are only a couple scenarios where a C corp may actually make more sense over an S corp or an LLC. One scenario would be if you have, as a single shareholder of a business, let's say that you are taking care of a loved one, an elderly parent, let's say, and you're paying $5, $6, $7 grand a month in-home hospice care, right? Where somebody comes to the house and makes sure that your elderly parent or family member is being taken care of, and it costs you a pretty penny to have that kind of service. C corporations are the only entity structure you see here on the screen that will allow you the 100% tax write-off for that medical cost. Under an LLC, an S corp, or even a sole proprietorship, medical is limited to about 7.5% of your overall adjusted gross income. I don't want you to worry about the details of how that works, but a C corporation is going to give you a much larger benefit if you have large medical costs that you incur for a dependent, whether it be a child or a parent, an elderly person, an elderly family member that you are taking care of and claiming as a dependent on your return. If you want to learn more about that, obviously set up a free consultation with Robert Hall & Associates, and we'll walk you through all of that. Probably the most unique and most beneficial entity structure under the current Internal Revenue Code is the beautiful and lovely subchapter S corporation. Now, the S corporation is not going to be used to hold title to long-term rental investments under. The S corporation, where its magic happens, or where its games are played, are around self-employed businesses, self-employed revenue streams. This works great for a lot of real estate agents where they are earning commission income. They have large overhead expenses, marketing, advertising, travel costs, E&O insurance, meals, entertainment, depreciation on vehicles, in-home office rentbacks. So the S corporation allows you to play a very unique game called the reasonable salary requirement, where you can bring in, let's say, 100 grand of commission income into the S corp, have $30,000 in, let's say, overhead. You got $70,000 in net profit. And on that 70 grand, unlike a LLC, C corporation, or a sole proprietorship, on that 70 grand, you do not have to pay certain types of taxes on the full 70 grand. Meaning that the S corporation gets to set up this really cool thing where it pays you a salary and you get to deduct your salary, your own payroll to yourself as a dollar for dollar write-off and leave the remaining portion of profit in the company that is not subject to self-employment tax. I have a better breakdown later on in today's presentation that we're going to go over, so I'll come back to that. But out of all three choices that you have here, the only entity structure that will actually save you tax each year is the subchapter S corporation. More likely than not, the C corporation, you're going to get hit with that double taxation rule. And then the LLC, once again, it saves you absolutely nothing in tax. It just creates greater liability protection. Now, some of you might be thinking, well, if I have a great insurance policy, maybe I don't need an LLC or an incorporated entity. I've already set up a living trust. Maybe I don't need the LLC. And maybe that's kind of a benefit where I don't need that very expensive insurance policy. Well, I want you to pump the brakes for a second, because the three doors that you see sitting in front of you, when you kick down those doors, it leads you into a completely separate room. It's not like all three doors lead to the same benefit. Okay. The LLC, the S corp, and the C corporation structures allow for greater asset protection through asset separation. A trust, which is the door in the middle, that does not protect you while you are still living. Right? One major life event has to happen in order for a trust to kick in any sort of benefit. And unfortunately, that life event is death. A trust only protects you from probate in whatever state that you hold assets in. So the LLC is meant to protect you from potential litigation, separating business and personal liabilities. Trust is meant to protect you in death. And obviously, we all need some type of insurance: health insurance, liability insurance, malpractice insurance, E&O insurance, any and all insurance policies that will protect us in case we're out and about doing what we do on a daily basis and an unforeseen event happens. So always remember that insurance is by far the most important thing for us to have out of all three things that you see here on the screen in front of you, because insurance is there and in place to pay out settlements in case an unforeseen event happens. So the way you structure it as you want to build wealth and grow legacy wealth and assets in your portfolio is to have the insurance policy there to protect you and attached to whatever asset you need to insure. The asset is then titled and owned under an LLC, an S Corp, or a C Corporation. And then the owner of the entity is not actually you anymore. The owner is your living trust. And while you're still alive, the living trust really is still just your social security number. The ownership in theory doesn't change, but if heaven forbid anything happens to you, you step off the curb into a parking lot, you get hit by a car, you heel over at your desk because you work in a high stress industry like the tax industry. I know it's a dark topic, but listen, things happen, right? So the trust is meant to protect all of those assets and your wealth that you've built for yourself for a smooth transition to your heirs, so that they don't have to lawyer up and fight the state of California in probate court. So this is the way to better protect yourself across the board, and to make sure that when you do pass on, that all of your assets are going to smoothly transition or transfer over to your next of kin or your beneficiaries. Okay, so keep all of that in mind. Now, I told you earlier that I'm going to break down how that S Corporation reasonable salary game works. Well, let's say that you make about $100,000 in net profit after all expenses are taken into account. So you've got $100,000 that you would be paying federal, state, and self-employment tax on. As a subchapter S corporation, by definition, you are no longer self-employed. You are now an employee of your own corporation, and employees receive W-2 income. So on $100,000 of net profit as an S corporation and now an employee of your own corporation, you are required to pay yourself a reasonable salary of no lower or as little as 35 to 40% of your net profit. So let's use 40% as an example. 40% of $100,000 is $40,000. So you've got a $40,000 W-2, you've got $60,000 in leftover profit. Now, why would you want to jump through all these hoops to incorporate yourself and then run payroll? And now you got a $40,000 W-2, you've got multiple tax filings that you have to file, so on and so forth. Well, what you've achieved here is proper tax avoidance, right? Not tax evasion. Tax evasion is illegal. Tax avoidance is not. Now, on the $60,000 that's sitting in your business, that is still considered to be taxable income to you. So you will pay federal and state income tax on the $60,000, and you're going to pay federal and state income tax on the $40,000. But out of these two figures, the $40,000 and $60,000, the only number that you're going to pay Social Security and Medicare tax on, also referred to as self-employment tax because they're one and the same, or self-employment tax is referred to as Social Security Medicare tax. The only amount that you're going to pay that tax on, which is 15.3%, is the $40,000 W-2, because the $40,000 W-2 has payroll taxes, right? Federal, state, Social Security, Medicare, state disability, unemployment insurance, employment training tax on the $40,000, which is overall about 15.3%. The $60,000 that's left over, once again, still pays federal and state income tax, but what you avoid on the $60,000 is 15.3% of Social Security and Medicare tax. So obviously, that's a pretty significant tax savings, right? This is how it further breaks down. If you're a sole proprietor or an LLC, remember that an LLC saves you nothing in tax. At $100,000 of profit, you're at about 25% federal bracket, 9.3% state, 15.3% self-employment tax. You could see that a majority of your money is just going right out the gate back to some sort of governing agency, right? Whereas the subchapter S corporation paying a 40% reasonable salary, nothing changes for federal and state income tax purposes. And I'm using California as an example here. So if you're not in California, you can ignore the second column completely and apply whatever your state tax rate is in that state. But where the magic happens is at the very bottom column, right? If I am only paying self-employment tax now on my $40,000 W-2 and avoiding 15.3% on $60,000 of my profit, on this scenario, you're saving about $9,180 in unnecessary Social Security and Medicare tax. I mentioned earlier that the net revenue figure, that milestone figure that we want to hit and be consistent at, is about 35 to 40 grand. I've cut this profit in half just to show you, even at $50,000, you're still having an overall net tax savings, Social Security, Medicare savings of about $4,590. Now, here in the state of California, to file your tax returns with a preparer, to pay yourself a payroll and have all the processing fees for payroll, and then pay California's parking ticket of $800. I call it a parking ticket. That's what you got to pay the state of California for parking your business in this state, $800 annually. When you add up all of those costs, it ranges between, let's say, $2,300, $2,400 and maybe $3,500 to $4,000, depending on what firm you use to file everything. Even at $50,000, you're coming out ahead. Because at $50,000 of net profit, once you play the reasonable salary game, it's still going to save you about $4,500, $4,600 in tax, which is still covering all of the costs that you incurred to file and make this all happen. This is the number that we need to sit down and calculate for our clients just to make sure that it makes sense for you individually to incorporate. Just because your neighbors, your coworkers, your family members, your friends, just because they incorporated and received a benefit doesn't necessarily mean that that same benefit is going to apply to you. So keep all of that in mind. You want to map a plan or map out a plan for you and your specific scenario. Now, back in 2018, whether you were self-employed as a real estate professional, a rental property owner, a property rehab or flipper, or maybe you're selling things online, maybe you have an Amazon online shop or selling items on eBay, this is all part of the qualified business income deduction section that's been around since 2018. And so one of the most important times of year for us outside of tax season, one of the most important times for us as tax advisors is year-end planning. So starting in September and all the way through December 31st, we like to sit down with our clients, map out a plan to wind down the calendar year, figuring out where your projected net profit is sitting, let's say as of December 15th, and then sending you out into the wild, right, back into reality to go and spend some money or reinvest money back into your business infrastructure to help further reduce your taxable income. And the goal here is to drop your taxable income low enough on your real estate rental investments, on your self-employed businesses, to drop you below one of the two thresholds. If you're married filing joint, you're going to go to the blue column. If you're single or head of household, you're going to go to the red column. A big part of year-end planning is also connecting with Dimitri and Sense Financial to figure out, hey, how much can I defer into my self-directed IRA, into my solo 401k? And that might be the tipping factor to get you below 364,200 married filing joint or 182,100 as a single or head of household filer. And at that point, if we can simply defer money into a retirement plan, maybe go out and purchase a company vehicle and accelerate bonus depreciation on the vehicle, that might drop us from, the $400,000 threshold down below 364,200 or 182,100. And now we are all qualifying for the QBI deduction. Now, what the heck is QBI? QBI is not a new variant of COVID, so don't worry about that. It did start 2 years prior to COVID, but it allows self-employed individuals who have qualified business income, i.e. rental property cash flow, self-employed income from a corporation with a K-1, or self-employed income on a Schedule C as a sole proprietorship, to make 20% of all your qualified business income tax-free. Let me give you an example. My wife is self-employed. Let's say that I am also self-employed. I'm not. I'm a W-2 wage earner, but let's just for example purposes, let's say that we're both self-employed. My wife is bringing in 150 grand in net profit. I'm bringing in 150 grand net profit. Together, we're at about 300 grand in overall net taxable income. Because we're both self-employed and both of our income sources are qualified business income sources, and we're below $364,200 at 300 grand, that means that we qualify for QBI, and 20% of $300,000 in net profit pays nothing in federal income tax. That is $60,000 in tax-free income on the federal return. Now, if I'm in the 25% bracket, let's say on $60,000, that's about a $15,000 tax savings just by planning ahead, right? If you're sitting above one of these two thresholds prior to the end of the year and you haven't maxed out your deferred comp, you haven't reinvested profit back into infrastructure, you haven't paid yourself rent back of the in-home office expense, played all of those games that the code allows us to play, you're going to be losing out or missing out on a pretty significant benefit here. Now, the phase-out thresholds are pretty high, so some of you might already qualify for it, and that's great. But for the individuals who are slightly above one of these two thresholds, depending on your filing status, you absolutely need to set aside some time to plan ahead to receive this tax-free benefit. I foresee this being around for quite some time because this is a stimulator of the U.S. economy right here. This allows self-employed individuals, real estate investors, to retain more of their wealth that they built for themselves so that they can reinvest back into infrastructure. Okay. I had a business, my business 101 teacher at Chapman University, where I went to college. I remember it was either first day or second day of class. And he said, there are 3 rules in business. Number 1, pay your employees, right? Because you pay your employees and they'll do great things for you, right? You always got to pay your employees. You don't want to default on checks and deposits, things like that. Rule number 1, pay your employees. Rule number 2, reinvest your profit back into infrastructure. Reinvest, take all of that revenue that you've made and reinvest it back into your business so you can expand, reach larger networks and geographical regions across the globe with internet advertising, so on and so forth. So number 2, reinvest profits back into infrastructure. And this is the one that really hits home, especially now that I've been a tax advisor for almost 20 years. Number 3 rule, pay as little tax as possible by exercising rule number 2. And now, I mean, when I was in college, I didn't really truly understand that. And as I entered into the tax world, yes, obviously that makes complete sense. The federal government will allow you a dollar for dollar deduction for 98% of your costs to offset your taxable income through rental properties and through self-employed businesses with legitimate, ordinary, necessary, and legitimate business deductions. Well, set aside some time prior to the end of the year to plan ahead to make sure that you're qualifying for all of these tax-free benefits. And every dollar that you're spending between that point and the end of the year is potentially going to be a dollar for dollar reduction in taxable income. So keep all of that in mind. I don't want to spend too much time on this, but this is just such a powerful tool under the current and future Internal Revenue Code. The thresholds will adjust with inflation moving forward. And I think that this is set to sunset either in 2027 or 2032. A lot of things are ending in 2027 and 2032. I believe this is 2027, but I'd have to double check on that. But we have some time to take advantage of this. I do believe that they will extend this part of the code in 2026 and 2027, though, because it's such a huge beneficial benefactor for growth in the U.S. economy here in the States. Before I get on to some other things, I did want to mention that starting in 2024, we have a new filing requirement for incorporated entities for businesses. It's called the Beneficial Ownership Information Report. And it's really unique. Our office can assist with filing this. If you incorporated yourself prior to December 31st of 2023, you actually have until next year to file this. And they did mention that you have 30 days from the original incorporation date to actually file this. But I believe, and Dimitri actually reminded me of this, is that I think that there's a 90-day extension in place. I don't think anything's changed around that. But you do have a little bit more time set in place for filing this if you are a newly incorporated business in 2024. If you incorporated before January 1st of 2024, you have some time to file that. But our office is available to help you set this up. I believe our charge for filing the BOI report is around $295. And the reason why I give you that cost is full transparency. It's a pretty darn easy form to fill out online. It takes about 5 or 10 minutes to fill it out. I think Dimitri actually filled out one himself. I filled out a couple already. You might as well save the $300 and learn how to file that yourself. It's very similar, in my opinion, to the Secretary of State renewal forms. And this is just really to prevent the government's perspective on this. This BOI report is meant to, cut down and prevent the bad actors. I've heard this term a lot on the news media outlets, on the IRS websites and updates and our continued education. These bad actors from concealing ownership to facilitate, I'm reading this off the slide because I always think this is interesting, facilitate illegal activities like money laundering, which is huge here in the U.S., terrorism financing, which I'm sure is huge as well, but that's above my pay grade, and tax fraud. I mean, that's probably the number one thing that they're trying to avoid. They are not going after the U.S.-based taxpayers who own businesses. They want to hone in on foreign individuals who are majority owners of U.S. corporations that are avoiding, or in this case, evading United States tax. So it's really not to come after us. It's just to get a better handle on what else is going on in the world and who is utilizing and taking advantage of the United States tax code and tax system. So keep all of that in mind. We can absolutely assist with filing all of this. I didn't want to spend too much time on this, but if you have more questions about the BOI report, absolutely reach out to our office and we'll do the free consultation with you. Okay. How do you pay yourself that reasonable salary that we discussed earlier? Well, you need to, once again, sit down with your tax advisor prior to the end of the year. We dial in what your projected net profit is. We give you a list of what you could spend your money on prior to the end of the year. Assuming that you go out and you spend that money, we look at that net revenue figure, and then we run a payroll for 35 to 40% of whatever that projected net profit is. And it's a pretty straightforward process. Obviously, if you know how to run your own payroll, by all means, do your own payroll. I wouldn't suggest doing that because payroll is pretty complicated. We actually use our preferred vendor, Paychex, to run payroll. And we do all of the connecting with Paychex. Alessandra Montanero, who's our Paychex rep, she's fantastic. Some of our clients have their own bookkeepers for their businesses, so the bookkeepers run the payroll. However you want to operate that side of your business, we can conform to that. But we need to run payroll prior to the end of the year for a number of reasons. One, to get the payroll in prior to December 31st, but also number two, to calculate what your allowed contribution is to your self-directed IRAs, solo 401ks, whatever the deferred comp, profit share even for some people, where their company is also going to contribute to their retirement plans on their behalf. Also to figure out, and this is one very unique scenario that I've seen over the past year, in the entertainment industry, because most of the studios and I think it was the actors, the writers, and one other guild that was on strike for almost 8 or 9 months. Well, prior to the strike, most of our clients were maxing out their deferred comp, maxing out their IRAs, their 401ks, so on and so forth. But in 2023, because of the strike, their revenue was like 60, 70, 80% less than the year prior. So all of a sudden, it's not that we were advising people not to put money in. We were just telling clients, hey, instead of needing a tax deferred retirement contribution as a deduction, let's max out any Roth contributions because you're in a low enough income bracket for that 1 year to max out the benefit of a Roth IRA. Maybe even doing Roth conversions where if you have a big SEP IRA or if you have a big 401k that has been tax deferred in this low income year prior to the end of the year, let's go ahead and do a Roth conversion into something that's going to grow now tax free. Sure, you pay the tax on the conversion because remember your 401k and your IRAs have been kicking the tax can down the road until you kick the can or until you retire, right? Until you start accessing that money and then you pay tax at that time. Instead of waiting all that time, because we have the ability in that 1 year to file tax returns at a lower income bracket, let's take the tax hit on the conversion in that low income year. And now moving forward, all of the growth in the Roth IRA account or Roth 401k is tax free. I did more Roth conversions in 2023 than probably any other year in my almost 19, 20 year career. So this is all part of the power of planning. And it can't be done if you don't set aside time to meet with your tax advisors prior to the end of the calendar year, okay? Now, I mentioned a couple things throughout the webinar about California and other states, how there are filing fees. And if some of you are in the state of California, you're thinking, how do I avoid the state of California's $800 filing fee? Can I incorporate elsewhere to avoid that California filing fee? What are the do's and don'ts on that end? Well, just understand that California, and I say this in the nicest way possible, California is probably the most unique state with the most unique tax code. And I'm holding back on some of my own opinions about California because California is the highest tax state in the US. We absolutely get annihilated at the end of the year when it comes to tax liabilities across the US. We are not only, I think, now the most expensive state to live in, close second maybe, or maybe we took first over New York. But New York and California are the two worst. We pay for the air that we breathe outside. Our utility costs are through the roof. So understand that California is unique. And California is one of about 7 states that taxes its residents on their worldwide income. So following that same kind of topic and that same sentiment, you can incorporate elsewhere. You can incorporate in Nevada, in Delaware, in Florida, in Texas to get some of the, in your opinion, the tax-free state benefit. Here's the kicker. If you register to vote in the state of California, you drive around a car with California plates, you have a California address on your driver's license. Unfortunately, you are a California resident by definition, and you will still have to pay California's filing fee of $800, but you have to file foreign jurisdiction in the state of California. Now, are there more complicated filing ways to avoid California's filing fee? Absolutely, but you got to set up land trusts and trusts in other states with ownership, majority ownership in assets that are owned by C corporate. I mean, there's a whole very expensive way to set that up. And if the numbers make sense, absolutely. But to have all of those structures set up just to avoid a measly $800 that happens to also be tax deductible, it might not make sense for you. Okay. So I'm not saying that you can or can't do that. I don't know yet, right? We need to sit down with you first to map out, one, if the costs are worth it to set all of that up. If the cost and the deduction of all of that is going to save you more than it costs you in the long run, number one. Number two, do you have a certain amount of wealth in your assets or your portfolio that need that kind of asset protection solely to avoid California's $800 filing fee? That's what I'm trying to say. So you can incorporate elsewhere for greater asset protection, but in most cases not to avoid California state income tax or filing fees. Okay, so keep that in mind. Another major benefit, especially during the pandemic, we saw people taking advantage of is when they are self-employed and they have a property management company, or they have a self-employed real estate commission earning business, or online self-employed business where they're selling stuff on eBay, Amazon, so on and so forth. During the pandemic, most people were working from home, right? They actually shut down their brick and mortar office buildings, or they weren't allowed to come into their buildings during the pandemic. So they set up in-home offices. So we saw more in-home office filings during the pandemic than ever before in my 19, 20-year career, which I love seeing. In fact, I've spoken to over 100,000 people in my career, and I can't tell you how many times in those seminars I've heard people say, well, I don't want to take the in-home office deduction because it has a higher risk of audit. It gives the IRS to look more closely at my return and to scrutinize things more. And that's not incorrect. That's not wrong. But I think that people need to understand why the government focuses in on the in-home office deduction more than other write-offs on your return. And it's not exactly that the form that gets people audited, it's the unreasonable allocation of square footage that gets people audited. For instance, if I sat here today and said that everyone should be taking 25% of their house as an in-home office write-off, well, I might live in a 1,000 square foot home. You might live in a 5,000 square foot home. And if 25% of your home is an office space and 25% of my home is an office space, mine's 250 square feet, where yours is over 1,000 square feet. Now, whether that's true or not, it's a different story, but the government's going to think and assume that 1,000 plus square feet inside of your home is not truly office space. I do have clients who have employees that work inside their house. They convert their guest bedroom, they knock down walls, they use the garage for desk space as well. I do have clients who have offices that big in their homes. Just understand that it's the unreasonable allocation that gets people audited, not the form itself, okay? When you incorporate yourself, you no longer file that highly audited in-home office form. You actually have a contractual agreement with your corporation to rent space inside of your house to the corporation, meaning that the 12 by 12 room inside of your house plus the nearest restroom, whatever that square footage is, you get to set up that as a Schedule E rental property. That portion of your home is a rental property on your individual return, and you are paying yourself rent per month or once at the end of the year out of your corporation, converting self-employed income into rental income. Now, for those of you who are veteran investors, you know that self-employed income is subject to federal, state, and self-employment tax, whereas rental income is only subject to federal and state income tax, not self-employment tax. So right out the gate, just by paying yourself rent, you're avoiding 15.3% of self-employment tax on whatever that dollar amount is. Now, you get to deduct the rent through the corporation, you claim the rental income on your individual return, and then you get to wipe out the rental income with allocations of mortgage interest, property taxes, insurance, improvements, little repairs to your office space, wall art, whatever you're putting into your office space. And on top of all of that, you get to take depreciation on that percentage of your property. All of a sudden, you're making 20, 30 grand disappear into thin air legitimately. Okay. And that's called the in-home office rent back ruling, where there's a 3 or 4 page part of the Internal Revenue Code that states that you can do this if you are an incorporated entity and you do have that contractual agreement in place. It's a wonderful tax shelter for a number of reasons, but mainly and specifically for self-employed individuals. Okay. Now, I know we're going to get into Q&A. I'm going to end here just to give you 3 ways to contact our firm for the free consultation. 1, you can send an email directly to me at TonyWatson@RobertHallTaxes.com. You can text Robert Hall to the number 72,000. So you actually type in the word Robert Hall, and for the number that you're texting, it's 72,000. Or you can use your smartphone, right, to scan that QR code at the bottom part of the screen. That'll prompt you to submit your information for that free consultation. It's 30 minutes either in person or over the phone. So if you're in the LA, Glendale, Southern California area, we're open for business. I'm sitting here in my office in Glendale, California, and we've got a number of appointments still open before the end of tax season. And if you don't want to do something before April 15th, push it out to the off season when things are a little bit more flexible timing wise for you and your industry, maybe. But we're readily available to assist. And I think that we've got some great Q&A coming in through the Q&A section, Dimitri.
Thank you, Tony. Great info as always. And yes, we do have a few questions, folks. This is the time. If you're thinking about something, if there is some unclarity in your head, then use the opportunity. Tony is the expert. He helped me personally a lot, save on taxes, and just a wealth of information. So don't lose that opportunity. There have been a couple of questions that came up that I answered. So let me go to Dijan, and he's asking, I have two questions. I live abroad. Are you versed in filing taxes for expatriates? I have two LLCs in Arizona. I'm the only member in both. One is a service business, which is a swim school franchise registered as S Corp, and the other one is for passive real estate investments, registered as partnership. Is it possible to draw dividends from either of these two businesses instead of W-2? If not, how should I structure these two businesses in order to draw dividends, not W-2 income?
Got it. So are we versed in expatriate type tax returns? Yes, we're well versed in anything that files with the United States government and the Internal Revenue Service. As far as tax code abroad, no, we do not do tax returns outside of the U.S. But the two LLCs in the Arizona, if they're single member LLCs, very straightforward as far as filing here in the U.S. is concerned. School franchise registered as an S Corp, and the other one is a passive real estate investments registered as a partnership. Very, very straightforward on that one. As far as you receiving dividends, so just understand that an S corporation and an LLC, they don't issue dividends. The only corporate entity that issues a dividend is a C corporation. So if you wanted to avoid W-2 income and the processing of W-2s, well, first off, let me back up. The partnership doesn't issue W-2s. Partnerships are considered to be self-employed passive investments or non-passive investments, where the K-1 that's passing through to you would already take into account what allocation is self-employed income versus what is just ordinary business profit. So I don't ever see W-2s unless the partnership has employees, and those employees are not owners of the partnership. Yes, there will be W-2s to the employees. But if you are an owner of a partnership, there's no need to issue yourself a W-2. It would just be a pass-through or flow-through K-1 from the partnership. The S corporation doesn't issue dividends. It's also a pass-through entity. So under the S corporation rules, if you have any sort of profit, you have to, by code and by law, by tax law, you have to issue yourself a reasonable salary. There's no way to take a dividend in place of a W-2. Now, the S corporation is a very unique entity because even though you're taking a W-2 at 35 to 40% of net profit, you can also do owner draws from the S corporation, which are not dividends. It's just you basically tapping into the retained earnings of the corporation. I probably don't have enough time to answer all of that question. I think that that's probably more warranting a consultation with one of our senior advisors. But yeah, structuring the business in order to take dividends versus W-2, you'd actually have to revoke your S election on the S corporation and make an election to convert the S corp to a C corporation. And at that point, you can void W-2 and take dividends. I wouldn't suggest doing that without the appropriate meeting with a tax advisor, simply because you might end up paying more tax on the C corporation side than you do as an S corporation. Okay, so just be aware of that. We got to map that out. But those are great questions, and everything that you mentioned in that question, we are very well versed in. Just as a side note.
Great, thank you so much, Tony. Moving on to the next one from Linda. She is asking, we are retired and have 3 rental properties that are producing some rental income. We are looking into more rentals to purchase. We have a real estate business. Every rental has an LLC. We have a primary residence that we are considering renting out in the future. Taxes are high in California. Is S Corp right for us?
So the only time that you would ever have an S corp in this scenario is if you were wanting to pay yourself a property management income, where through all of your LLCs, you are taking some of your rental income, paying it over to the S corporation, and then allowing yourself to play some of the games under an S corporation. I'm not opposed to this idea, but remember, one of the major benefits of having only rental cash flow is that your rental income and all the profit that you make through your rental investments will never have to contribute to Social Security and Medicare tax. As soon as you take some of that rental cash flow and pay it to yourself as a management income, sure, it opens up the door to max out self-directed IRAs, solo 401ks, purchase vehicles under the S corporation, so on and so forth. But now you are forcing yourself to actually pay yourself a salary under a self-employed business and forcing Social Security and Medicare tax, an additional 15.3% of Social Security Medicare tax on income that technically at its inception or at the starting point never had to pay Social Security and Medicare tax. I have specific scenarios where a client inherited a shopping center, and no matter what they do, no matter what kind of money they put into it, it's still profiting $300,000 to $400,000 a year. You know, they would have to make significant improvements to the shopping center, and they already have done that prior to their parents passing away. Their parents passed away. They left the children the shopping center. It's just an incredible cash flowing asset. Even with depreciation, because they get the stepped up basis, they restart depreciation. Even with depreciation, they're still cash flowing. So in that scenario, they wanted to start retirement plans. They wanted to put their kids on payroll. So we had them start up their own S corporations, pay themselves management fees, and then obviously max out deferred comp plans, purchase company vehicles, put their kids on payroll, so on and so forth. But if your rental income is already being wiped out down to a zero net profit or a loss with depreciation, insurance improvements, so on and so forth, I wouldn't suggest doing any of this. I wouldn't suggest an S corporation. If anything, keep yourself as an LLC until the debt is fully paid off and the cash flow is significant, and or if depreciation is on the very tail end of depreciation, and now you're starting to cash flow because you lost the depreciation write-off after 27 and a half years, let's say, for residential. At that point, once you have that significant cash flow, the S corporation as a management company might be an option for you. It really is hard to tell without knowing all of those details and the breakdown of that scenario. But I'm not saying yes or no. I think that it might be.
Okay, thank you. Moving on to the next one. A question from Bosco. I'm a partner in a large partnership and get a K1. Is this possible, or I'm sorry, is this considered self-employment income, and can I set up a solo 401k and contribute to solo 401k from my K1 income?
So, and Dimitri, we'll probably have to tag team this one, but it really comes down to whether or not your K1 from the partnership shows guaranteed payments for services, and that's allocated as self-employed income. If that partnership is not allowing you to set up a retirement plan with the partnership, I do believe that because the K1 passes through to you in this scenario as self-employed income, you can have a self-directed IRA for that K1. As long as the employer, as long as the partnership is not providing that benefit to you, you have the ability against your self-employed income to defer tax into a self-directed IRA. Dimitri, I don't know if you have anything to add to that, but that's how I understand the rules. Because K1 is very similar to a 1099, it is all self-employed income at the end of the day. Once again, depending on how the partnership is filing the K1s, because K1s sometimes just show it as ordinary income, not considered to be self-employed income. And at that point, once again, it has to allocate certain amounts of your profit to guaranteed service, guaranteed payments, which are considered to be self-employed income sources.
Yeah, so I mean, solo 401k can be established for any business or self-employment activity as long as there is no other employees that are employed by the business who are eligible, because solo 401k cannot accommodate non-owner employees. So yes, I guess, Tony, you'd have to look at the tax return and see how that K1 is reported. But I think I've seen that in the past. The similar question come up in the past, and my recommendation was, hey, why don't you set up a S corp and have your S corp be the partner and receive that K1? Is that accurate, Tony? Is that a good strategy?
Correct. So that's actually how I have a lot of my partnership clients set up, is that when they work for a larger partnership, the K1 will come through. And this is unfortunately something you have to go to the partnership and make sure they're okay with doing. Instead of paying you personally as a partner, you can set up an S corporation to receive the K1. The self-employed income comes through the S Corp, and then the S Corp would then set up its own payroll to you as the shareholder of the S Corporation. And at that point, we can do self-directed retirement accounts plus profit share from the corporation, acquire corporate assets, so on and so forth. I don't see that very often, though, because the partnership has to make that decision of whether or not they want to pay you as a subchapter S corporation. So you got to make sure that before you set all of those things up, that whatever company you're working for, like the Kaiser Permanente, for instance, they won't pay subchapter S corporations. They'll pay their doctors as K1 partners, but they won't allow corporations to be paid with K1s. So there are industries that won't allow for that kind of benefit. If the partnership says, yeah, we'll pay whoever, just give us an EIN number, give us a copy of your articles, make sure that you have your own liability insurance. Boom, K1 comes to the S Corp, and then we can set all of this up. And that's not a problem. We have several clients set up that way.
So, Tony, to piggyback on what you said, Kaiser, and I think I spoke actually with doctors who are like that. So, a doctor working for Kaiser gets a K1. How will that income be reported on their taxes?
K1 is going to be reported as self-employed income. So they're going to have self-employment tax that is generated on what box 1 and box 4, or box 1 and box 5. I forget if it's 4 or 5, but box 1 is going to be their total income that passes through. And then box 4, box 5 will be the amount that's subject to self-employment tax. Now with my Kaiser clients, their K1s already come with allocated deferrals into their KEOG plans, their whatever those IRAs are. So I don't think that Kaiser, because they offer that retirement benefit for their doctors, I don't have any of my Kaiser clients with their own retirement plans because Kaiser already sets that all up. But the K1 from Kaiser would be considered to be self-employed income. It's taking the place of a W-2. The power behind a Kaiser K1, though, is that you can write off what are called UPE expenses. Unlike a W-2 where you can't write off anything against the W-2 outside of what your primary residence mortgage interest, property taxes, which are limited, and charitable contributions. If it's a K1 over a W-2, the K1 as a partner, you can write off UPE costs. UPE stands for unreimbursed partnership expenses. And those expenses like a car purchase, meals, entertainment, travel, education, all of that can further reduce the K1 taxable income and help save you tax. You can't do that with a W-2. So that's one of the main differences. I do believe that Kaiser, though, in this specific scenario, they already offer the KEOG plans and the simple plans for their partners to invest in.
Yes, thank you. Another question from Nick. I have 3 rentals worth about $1.5 million, which I own free and clear, which I did 1031 exchange into. The basis of the original property was about $200,000. Any recommendation on the strategy to liquidate some of it and minimize the tax liability?
Well, in a 1031 exchange, the whole benefit is to defer the capital gain and to access some of that equity. You'd either have to do a HELOC, so an equity line of credit, which is not taxable to you. You'd have to wait till the exchange finishes, and then you tap into the equity on the property. The only other way to access funds out of that exchange is to do a partial exchange, where instead, let's say you've got this massive capital gain of $1 million you're trying to defer. You do $800,000 in exchange. You access boot of $200,000. I'm being very general with the calculations here, but you access boot out of the exchange and you exchange the difference of $800,000. So you only pay tax on the $200,000, but you'd have to exchange it again to do that. Right now, because you're already settled on the exchange with a low basis, your best bet is to do a HELOC on the property. You could go to other financiers, like for instance, I know that Merrill Lynch gets really creative with what's called asset leveraged financing, where they will let you borrow money against equity in your brokerage accounts and your real estate accounts, similar to a regular HELOC, but at a much more competitive interest rate. Right now, it's still going to be in the mid 5s, I think, but much lower than the 6.5% to 7+% range that we're seeing nowadays through conventional financing options. especially compared to hard money lending, which is what, 11, 12, 13% right now. HELOC would probably be the first point to get equity and to get cash out of that property without having to do another partial exchange and paying tax on the boot.
Gotcha. Okay, let's move on. Rick is asking, is QBI the same for passive Schedule E rental income?
For anybody who makes under the threshold, yes. So anybody who makes under the threshold of 300 and whatever the slide said, the 182, 100, and 364, 100 or 200, I forget what the number was, then everybody would qualify for QBI. There are certain industries that are called specified service and trade businesses where they won't qualify. Rental income, because it's qualified business income, should in theory qualify, but it really all depends on what industry you are working in. If it's just a rental property, then yes, anybody under that threshold will qualify for QBI. But if it is, if you are not actively participating in that property, if you have a property management company managing that, then no. And my assumption is that if you're checking passive on that investment, then you're not actively participating. For instance, I have properties in Austin, Texas. I do normally have property management companies managing those. There are 2 properties that don't have a property management company, and my brother and I just kind of maintain them individually. Those ones, I don't qualify for QBI because of my wife's income being added onto mine. But if I were under that threshold, my property management companies or my property managed real estate would not qualify for QBI, but all the ones that I didn't have a management company on would qualify as long as my income was below one of those 2 thresholds for married, filing joint, and single head of household. Probably the best thing to do, just to make sure I'm giving you the right advice and the correct answer, is to take a look at your 2022 or 2023 tax return to figure out what might be limiting the QBI on your tax filing. It's really hard to say without seeing the actual numbers, though, as to why you did or did not qualify.
Okay. Next question from Jeff. My wife has a sole owner LLC rental property that she manages herself. Can the LLC set up a home office rent back for her? Married filing jointly, can we do the same for our S Corp? We each have our own offices within the home. Any problems with this?
So I wouldn't set up an in-home office for the sole owner LLC rental property because the rental properties are not self-employed businesses. Even though they are businesses, they're not self-employed businesses. So the in-home office deduction would only work if you had self-employed income revenue streams. So my assumption is that this S corporation that you have, it says married filing joint, can I do the same for our S Corp? I assume that your S corporation is a self-employed business. That is the entity that you'd want to do both the in-home office deductions for. If your wife or you are not employees of the S corporation or not actively, if both of you are not shareholders of the corporation, what I would do is I would just make the in-home office deduction rent back game large enough to cover both your wife and your office space. Once again, it's hard to tell without seeing the actual tax return. These are very generic and general answers for you. But I think it's best to take a look at the return and make sure that that's the correct advice. I would not do an in-home office for the LLC rental property, though. Well, it's not that I wouldn't do it. It's just it doesn't work the same way. You'd have to do it through the S corporation to get that benefit.
Gotcha. Tim is asking, if I have other rental properties apart from the IRA, am I able to place them into the LLC in the IRA? Understand they are not subject to the IRA tax rules. Well, I guess that question is for me, and the answer is no. You cannot commingle your personal assets with your IRA, so that's not possible. Okay, and last question here from Jeff. I do have a sole owner LLC rental property that I manage. Can that company also rent back home office deduction? Well, I believe that's kind of maybe a clarification for the previous question that Jeff asked.
So yeah, once again, the LLCs, they don't get to play the same rent back game as the S corporations do. So if you have one S corporation, that's where your benefit would land. It wouldn't be under the 2 solo owner LLCs. It would be under the S corporation that we would do the rent back of in-home office game.
Okay. We got one more here from Linda. I forgot if I read that, but let me read it again. Let me know, Tony. We retired and have 3 rental properties that producing rental income. I think you answered that.
Where I'm looking in the Q&A section. I don't see.
It's towards the top. Yeah, I think I did read that one.
The clarification, we are
Linda,
retired and 3 rentals. Yeah.
Reach out if you need further clarification. Well,
Yeah, I think we did cover that one, though. I think we did cover that one.
Well, this concludes our webinar for today. Tony, thank you again for joining us. Lots of info. Guys, thank you for participating. Lots of great questions. I'm sure others benefited from your questions. I always say I'm personally learning just by listening. Somebody else asking questions, and I'm sure the questions you ask were beneficial to other people as well. Have a great rest of the day, and we'll see you on our next webinar.